Hi everyone. I hope you're back. If you are, do switch on your cameras. Once again, we really love to see all of your faces throughout the session. We're going to head into our third session for today by Dr. Tan Swee Liang herself. And she's an associate professor of economics from the School of Economics of Singapore Management University, as well as a council member of the Economic Society of Singapore. Now, today's text can help SMEs drive Singapore's productivity. Please join me to welcome Dr. Tan.
Hi, thanks very much, Jasmine. Maybe I'll share a little bit about my motivation for this topic. Part of my research interest is to look at growth, economic growth. And as a country matures, we expect sources of growth that comes from, capital, or the fact they have more and more population growth. That starts to be, reaching its peak, or for some countries have already reached its peak. So other sources of growth would be what we call total factor productivity. And what to me is interesting is, how technology could be used, to drive productivity growth. And because of my background in finance, I'm interested to look at, when financial institutions or financial markets, or talk a little bit about alternative financing, which is crowdfunding, how when you have financial services and technology coming in together, and what role it could play to drive productivity growth. So that's why the fintech bit and economic productivity. But what about the SME bit? How does this third component come in? To me, my interest in SME actually began many years ago when I was an economist in Standard Chartered Bank and based in Singapore. And SME Standard Chartered Bank has got clients, corporates, and so forth. And there was then a request for an economist to go to, it was Muar, it's a town in Johor, to share about, what we economists see, what's happening in Singapore, Malaysia, and the region. So I met up with a group of SMEs, and they were mainly in the furniture business. And when I shared data, etc., then I realized that there's actually lots of data that perhaps the SMEs were not they are not aware of. So when I shared this data with them, they found out they were really useful. And of course, the other interest is in SME. It's got to do with inclusive growth. That as an economy grows, how do you make growth inclusive? That then includes as well the micro, the smaller, and the medium enterprises. So in a while, I'll share with you some data about the contribution of SME to an economy. Its contribution in terms of its value add to GDP, its contribution in terms of its employment. And what is interesting is that, of course, SMEs grow when they have sufficient finances, right? And so I'm going to show you a link. We'll watch this video together, about the role of SMEs. So we're going to watch that video together. And so if SMEs then relies on financing, ease their cash flow in terms of working capital, etc. And the idea is that when they have access to this, they can then grow. And grow, I guess in Singapore's case, not just locally, but you do want them to grow as well regionally and so forth. So, and where do then these SMEs get their financing from? We're going to show you a flow of funds, from savers to borrowers, in this case here, the SMEs, through what we call direct and indirect financing. So that's just a standard, way that when we teach students, or that's the flow of funds in the financial system. But increasingly, there is alternative sources of finance. And for the purpose of this talk, I'm going to look at crowdfunding or fintech platforms. And this question is something that I've always been thinking about. When we put together all these components, economic productivity, merging the use of technology in financial services and SMEs, but that's always been at the back of my mind. Can fintech help SMEs drive economic productivity? And I guess my question is, well, it depends. It depends. And I'll end off with why I say it depends, yeah, in a while. Okay, so with this, I'm going to, we'll watch this video together, and then I'll put you in a breakout group. And my questions are actually very straightforward. It's just get us to think about, as you watch the video, and also get you all to read an article, yeah? What surprises you? What did you find? This is new, this is interesting. And I would love to hear from you what surprises you. And I'm going to assume that, because when I saw the profile, there are students from the universities. I could see some of the students that I thought as well you've signed in, so thank you for that. And there are also teachers, yeah, from junior colleges. So would like to hear from this group, and also, you know, the public in general, what you see are two economic concepts that you found that, hey, I've applied it, and I'm not able to analyze the video or article content much better. All right. So I'll put you in your group. We won't spend too much time, but I put you in your group, and I'll invite you then to discuss with your team these 3 questions. Okay. All right. So before I do that, let's watch this video together. Okay. It's a introduction. It's from the IMF, and so the idea is to give us a sense of, you know, what is the role of SMEs in an economy. Okay.
The role of SMEs is quite substantial in many countries, especially in emerging and developing countries. SMEs account for a large share of total employment, job creation, and GDP in many emerging economies. Now that is really important, especially if we take into account that 600 million jobs will be needed in the next 15 years to absorb a growing global workforce, mainly in Asia and sub-Saharan Africa. Now, new jobs boost living standards and foster social cohesion in a country. And therefore, SMEs are one of the main factors of economic growth and social peace. Without a robust and healthy SME sector, this cannot be achieved. Let's take the example of South Korea. While that country is associated with giants like Samsung, Hyundai, LG, SMEs in Korea account for more than 80% of total employment and about 50% of total value added. SMEs also played a large role in the transformation of Korea into a high-income industrialized country during the last quarter of the 20th century. Not surprisingly, SMEs are always high on the agenda of the government there. Of course, we should not conclude that all SMEs are drivers of growth and job creators. SMEs can differ greatly in their role in the economy. A lot depends on the skills of individual entrepreneurs, their attitude, and willingness and ability to grow their business. But on the whole, SMEs play an important role in many economies. And on average, they contribute more to employment in low-income countries than in high-income countries. Now that we have established that SMEs play an important role in many economies, what can we say about SME finance? Well, the first thing to note is that SMEs do need external funding. Of course, all enterprises start small, and at the early stage in their development, they use primarily internal funds, the owners, their families, and friends. But eventually, in order to grow, SMEs will need external funding. They need external finance to grow, invest, and acquire new technology to increase productivity. Without financing, they may not be able to expand, to compete in regional and/or global markets, or even establish business linkages with larger firms and position themselves in value chains.
So I hope that gives us an idea, all right? Then there is an article that I would like you all to read, and maybe if we could spend 5 minutes, all right? We'll all just stay in the main room first before I put you all in your breakout group. And this is the article is given, it's Channel News Asia, and it talks about how alternative lenders are helping fund the SME, what we call the funding gap. All right, so I think I have this article here already.
Yep, it would be the third link that I've sent in the chat.
Yes, okay, so if I could
The
invite
third
you all.
link would be the article to read.
Yes, okay. Okay, this one. Let me just open it as well. Okay. So 5 minutes, yeah, on your own. Okay, another minute or so, yeah. Okay, all right. So I hope you've enjoyed, yeah, reading the article. I'll do a breakout group now. Let me see how many participants we have. 18. Okay, so maybe we'll just have four rooms. Yeah, okay. And just 5 minutes and in your group, yeah, to share what surprises you, yeah, when you watch the video, and to identify 2 concepts that can help you to apply and analyze this content. Okay, so this session is about economics in the news. Yeah, so the news that we're looking at is crowdfunding, SMEs, and economic productivity. So let me do the breakout room now. Okay, so actually we have that already. Let's recreate. Okay. Let's just have 4, huh? Okay, because when we remove the codes and so forth. Okay. Okay, so I'm going to open all room now. And just 5 minutes, all right? Okay.
Once again, you should receive an invitation to join the breakout rooms. So please go ahead and accept that and you'll find yourself in a breakout room. Okay, for those of you still in the main room, you should see a message to join the breakout room. So if you can, please do join one. And do let me know if you have any difficulties accessing the rooms.
There's just one person in room 4. So Jasmine, I'll just go to room 4, yeah? And I'll be back in about 2 minutes or so.
Sure thing.
Okay. Okay. Hi, so welcome back. I guess in my segment, I'll share a bit about, these aspects of fintech, SME, and economic growth. And most of my references comes from the work that I have done in SMU. And also a course that I taught, yeah. So I spoke about flow of funds. You have, in this case here, you have households, you have business firms, governments. These are the lenders. So people like you and I, we save and then we lend. And in the context of lending, for example, we lend to the bank, yeah, and we call this the indirect financing, or we could invest, all right? We invest in the financial markets. And in economics jargon, we call this indirect financing, yeah, and we call this direct finance. And our funds, yeah, indirectly or directly goes to a group of borrowers, yeah, or spenders. All right, so that's the context of it. And these are the way we traditionally see it of how funding funds flows, yeah, from direct to indirect finance. And in today's segment, I want to talk about alternative financing, different channels that SMEs could get their funding from. Okay, so what is fintech? It's a short form for financial technology, and it's about combining what we see as latest technological developments And David has shared a little bit about, cryptocurrency, cryptography, artificial intelligence. And the idea is you combine the latest technology that's available in terms of how then to improve the way financial services and applications can be done. So I spoke to Maggie just now in the breakout room, and she shared about the app, that she has built. So this is where fintech comes in, Maggie. So an example of fintech comes from the use of mobile phone, the apps that developed, and financial services could be in the form of payments, lending, and borrowing. And the idea, of course, is that you have consumers who are unbanked, or you have SMEs who are not bankable because the banks may perceive them to be high risks. So how does then fintech help in to enable these unbanked consumers to access financial services for the first time? And so the idea is to promote financial inclusion. Okay. Here is just a diagram that breaks down, in this case here, the different types of financial services. We pay using credit cards, we save with fixed deposits, time deposits, we borrow. And financial services could be in the idea of managing risk, where companies do hedge their investments, for example. And then these are the ways, the different types of...
Sorry, Dr. Tan, I think you're not sharing the slides right now.
Oh, I'm so sorry. Okay. Okay, because, okay, yep. Yes. Share screen. Okay.
Oh yeah, it's back.
Is it all right?
Yep,
okay,
that's good.
Yeah, sorry about that. So I spoke about how the funds flow, direct and indirect. And then I spoke about the different types of financial services and the different types of technology. Okay, so that's kind of where we are. I'm going to, maybe for some of us, if the notion of fintech is new to us, or peer-to-peer lending is new to us, I'm going to show you this, this model here, all right? And the source is from Bank for International Settlements. So similar to the direct and indirect financing story, you have borrowers, okay, and then you have a group of lenders. And then you have the lending platform. So one of the, there are two fintech companies that was quoted in the newspaper that I got you to read. One of them is Validus and the other one is Funding Societies. So you can think about them as lending platforms. And the lenders in this case here will identify who are the borrowers. There will be investments, fact sheets available. And the lenders can then decide whether and how much they want to lend to these borrowers through the platform. The money though, doesn't just sit in this platform. They have what we call a escrow account, and just to ensure transparency. Okay, so funds are then provided, and then there is the repayment. And how the lending platform earns their income is through a percentage of the repayment, or a percentage of service fees for the provision of funds. So in the case of the lending platform, they will share fact sheets about investment information. You could go in and you could then classify whether you're high risk or you're low risk lender, and that will then link you up to the appropriate borrower here. Okay, so credit risk analysis is done by this lending platform. Okay, so it is a platform that provides an online market, it's a market, and it allows lenders, in this case creditors like you and I, to trade directly with the borrowers. Okay, so that's a very nice picture, I guess, summary of what a traditional peer-to-peer lending model looks like. So the features, as I mentioned, is that borrowers are provided a range of credit information that is posted on the platform after it's been verified and is approved by the platform. And then you have the creditors. So these are the creditors, and they can then choose. So like you and I, we can choose to fund loans that's available on the market. I think importantly is that when there's a contract, it's established between the borrowers and the creditors rather than the platform. Okay, and as I said, the funds, the contractual loan repayments, they are segregated. They have what we call a separate account, escrow account. All right. So don't worry too much about what you see in these slides here. But I just want to share that as an economist, we have questions that we want to ask. And we have certain frameworks that we can use to answer questions. So questions like, for example, that we ask in this paper here is that how does the existence of crowdfunding helps the SMEs in their cash flow? So this is where you could run very simple regression to more complex ones. And I just wanted to share that we did something like that, and we found that actually increasing volume of crowdfunding actually helps to reduce or improve, in this case here, the SME's cash flow. So we saw a negative relationship here, and that to us is good, because it shows us that, you know, having more crowdfunding helps to reduce the number of days to turn cash, which means that the debts could be settled more quickly. Okay, so again, main point on stress is that there's framework that economies can use in order to answer questions like, you know, how important is fintech in helping the SMEs cash flow. If you are interested in this sort of research, I'm happy to talk to you after this segment is over. But we also want to know if we find that there's a positive relationship or negative relationship, whether they are significant or not. And again, economics has the tools and means to answer questions like that. Okay. And so I've shared with you direct and indirect financing. Of interest, I guess, to policymakers as well is, yes, you want to develop your banking sector, and yes, you want to develop your capital markets, your stock markets. And what is also interest to economies is what is the relationship? Do they cannibalize one another? If, let's say, you have capital markets, stock markets that do very, very well, will that cause the banks, you know, to lose its market share? Or vice versa, if the banks do very, very well, will that cause the stock market to lose its value? Some of us may think of, you know, I have funds, I'm a saver, and I could decide whether to put my money in the bank or to invest in the stock market. And the notion seems like there is a competition, right? That when the size of one channel increases, it just means that there's less funds to the other channel. So again, economics provides us the tool to then see, well, what is then this two-way relationship, right? If the banks are efficient, do they enhance or do they hinder the workings of the capital market? And then vice versa, you know, if the capital markets do well, do they enhance or hinder the banking efficiency? And because I shared with you, these are the two traditional sources of funding, there is now alternative financing. So what if you include fintech in it? How do they affect the whole relationship? Do they play a complementary role or do they compete? And I think when the existence of, when fintech first came into place, there were a lot of tensions, right? Because banks perceive that if borrowers were to borrow from the crowdfunders, it means that they have less, right, clients. So it was seen more, less as complementary, but more as competitive. But one of the, if you read the article, the CNA article, there's this chap called Mr. Kelvin Teo. He's the founder of Funding Societies. So we did a case study, and he actually shared that for this peer-to-peer lending platform, they are actually serving a part of a clientele that the banks do not want to serve. Looking more at the micro and the small enterprises, because they are small, they are medium, and they don't have much history behind them. So banks tend to be quite reluctant. Right? So increasingly, we actually see fintech lending playing more of a complementary role rather than a competitive role. And increasingly, we are also looking at whether do these peer-to-peer lending platforms, do they co-evolve? So co-evolve would just means that if one segment do well, it actually pushes the other, wake up, you know. So perhaps in this case, we look at banking become more efficient, and results seems to suggest that with the existence, the presence, and eventual development of fintech, banking efficiency has increased. And when I talk about co-evolving, we could see that as banks become more efficient, then you see also the fintech companies, yes, stepping up on their game. And we seeing part of my research here is also to look at how they are co-evolving in terms of size. Yeah, so you may have, for example, a stock market, banks that's really, really big, but unfortunately it's not liquid. You know, they're not trading with one another. So the frequency of trading volume is very, very low. Or it could be the efficiency of it, right? Yes, lenders put their money in the banks or so on, but these funds are not efficiently being distributed to the borrowers. So these are the three dimensions that we look at: the size, the frequency, and the efficiency. And now with the emergence and over the last 10 years or so, with fintech, of interest to us is that not so much of can they help. When I put it there, can they help? I guess it's more provocative, but I think if I want to frame it correctly, it would be, what can government do? Right? David talked about in G we trust, right? In God, in gold, in government. So to what extent can government help? There's all these three different channels coming together so that we can then help the SMEs to drive economic productivity. So again, as I said, don't worry so much about all this, but I just want to show you that there are tools that we answer this question here. And in the first tool that I showed you was just a very basic, simple regression. In this tool here, it allows us to actually combine this two-way relationship. At the moment, I don't have the three-way relationship yet because we just got the data just about 2 weeks ago, and we really need to clean up the data. But by and large, we could see that for ASEAN 5, for example, when banks do well, when banks loans, the loan growth, now when banks loan increases, it helped us increase the stock market volume. So this one is interesting. And what about the other way, the other relationship? If the stock market do well, do they have a significant relationship with the banks? Well, our results shows that there's no significance in the relationship here. Okay, so this is when I did a study looking at all the ASEAN 5 countries together. I could do the same. And show it for Asia 5 countries like China, Hong Kong, India, Japan, South Korea, to look at this relationship here. So when we as an economist, when we look at economics in the news, I guess our training is that we will then we'll try to frame, these ideas here. Okay, so this is for Asia 5. Okay, I'm not sure whether if you have some in the chat. One of the questions that I asked was, hey, were there any things that you found? Let me see, there's any, economic concepts that you could use. So one of the things I had in mind as an economist when I read the news is the idea of transaction cost. So very simple supply-demand model. And really all we wanted to show was that, when cost reduces, it helps to improve the volume, the quantity of transactions. And this is what we hope to see, that as the cost of perhaps the loans, for example, transaction cost of taking a loans, etc., decreases, it will actually increase more transactions. And the transactions I'm looking at is loans. Okay. So a lower transaction cost is something that perhaps we could look at. So institutions that facilitate low transactions can boost economic growth here. The other concept that perhaps I would like to introduce to you is the idea of information asymmetry. Not sure about you, but sometimes, you will find that you are a car buyer and you want to buy a second-hand car. It's a very uncomfortable feeling because the one that sells you the car actually has got more information about the quality of the car than you as a used car buyer. So this is what we call information asymmetry, where one person has got more information than you. right? And in this case, and information asymmetry is no good, because when that happens, then of course, if you're not sure about the quality, you would then have a situation where there will be no used cars being transacted. All right. So likewise, in a loan market, you would have borrowers and you would have savers, and there will be that information asymmetry that you experience here. So the role of a bank, therefore, is how to then reduce this information asymmetry, right? And so these are banks will then do the profile checking, yeah, of the borrowers and try to make the information more symmetrical. And because when that does happen, then you as a lender will be more comfortable, yeah, to lend your money to this borrower. So, and this is where fintech, yeah, peer-to-peer platform has come in that they try to then make information available to the lenders, yeah, so that you're comfortable then to part with your money, yeah, to lend to the SMEs. Okay, so very important then, yeah, the use of technology to improve information asymmetry here. And of course, over the last 3-4 100 over years, banks, yeah, have played that role very, very well. But nonetheless, yeah, there are still segments of SMEs that are being underserved. Okay, so I did share when I was in one of the group with Ken and Maggie about the SME data. So in Singapore, yeah, SME makes up about 99% of all companies. They employ about 65% of the workforce and they contribute to about 50%. So you'll find that, my gosh, it's fascinating. But if you look at the share of total bank credit to SME, it's actually very small. It's about 13.4%. Banks lend about 50% to large corporates and the remaining 40% for consumer loans. Okay, so I think it's quite interesting. I know that, oh my gosh, they play a large role, but the amount of loans that banks give to them is actually relatively small. Okay, so this one shows the share. I give you that number, 13 point something percent, 13.4. Yeah, that's less than 15%. So it's always then good to benchmark, this number, 13.4%, vis-a-vis what's happening in emerging and advanced. So you'll find that in emerging economies, it's about 20%. For advanced economies, about 30%. All right. So I think that gives us a good idea of where we are, yeah, versus when we benchmark against some of these economies here. There's been surveys that's done about, well, how easy is it for you to get funding? So for small and micro enterprises, interestingly, when there was the survey done by Experian, it's a company and they work together with the Singapore Business Federation. And the numbers do suggest that for small and micro enterprises, because they lack collateral, they also have limited credit information, they do have difficulty in getting a bank loans. Okay. This is a more recent survey in 2020, and it was found that 61% of SMEs actually have a lower credit rating here, so which makes them actually quite vulnerable to short-term vulnerabilities, to adverse economic conditions. And as I said, government plays a very, very important role. And the MAS works very closely with Enterprise Singapore. Enterprise Singapore is actually one of its role is to look into SME development. So because of all this support, what you've seen is that, okay, I want to show you that the rate. I think in the article that you read, Kelvin Teo says that, actually the share of fintech lending has fallen a lot. And it's got to do with government stepping up and making loans, a lot more attractive for the SMEs. So if you look at this fixed rate, it's about 0.1% per annum and 0.5% per annum. And the tenure is about 2-year loan. Okay, all right. So if you look at the SME loans outstanding, amount of loans, that is given from the bank, that has actually increased. So during the pandemic, government support, bank support, the SME lending, loans has actually increased. And also so has the number of SME customers. So this one shows the after during the pandemic, what has government do and how have banks stepped in? Okay. And of course, you can take a look at this article, but more and more regulators, they have actually warmed up to the idea of having non-banks, better deploy technology, data analytics to tackle the financing needs that might be missed by the incumbents. And the incumbents here, they're referring to the banks here. Okay, so lots of government support in this case here. What I found is interesting, and I would like to share with you here, is if you look at the SME capital markets, so the volume of shares that's traded, so this is Catalyst, is the stock exchange for smaller size companies. I think this is worrisome. You've seen that market cap has come down. You've seen that trading value has also come down, and so has the trading volume. So if you remember, there are several sources of funding for SME. You have the banks, you have the stock market, and then we also talk about alternative financing. So I think the worrisome part is watching this coming down. So I think there's less support of funding now through this channel. We saw in the previous slide, banks together with Enterprise Singapore and government MES, that they have stepped up. So we see that bank lending has actually gone up again. Okay, all right. So I have come to the end of this segment. So this is Economics in the News. That's my session 3. I hope after this session, when you read the newspapers, there's a framework that you could look at. And there are 3 frameworks I hope you'll take away, which is that is there to address what's the potential for fintech to mitigate asymmetric information problem because of adverse selection, because of moral hazard, using technology. By that, AI, big data, machine learning, and digitization. And I hope I've convinced you, through the simple work that we did, that crowdfunding can help to improve SME financial access, which is improving cash flow. And that lastly, government's regulation, to promote is actually very, very important. Okay, so I've just left the 5 minutes here to see if there's any questions from anybody. Okay. But if not, Jasmine, I know I'm in between everybody and lunch here. So